Good afternoon. I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our regular collection of financial perspectives for the week ended Friday, July 10th. As we've said from week to week, these are historically challenging and very interesting times, and they can be a little difficult for investors to navigate on their own. We understand that. We currently at Foster Group work with over 1,400 clients who we really, truly care for. It's our pleasure to help with all aspects of their financial planning, including how they invest and how they protect their assets, how they give, especially in uncertain times like these. We like being helpful, and if you are in need of that kind of help, we would welcome a conversation with you. Or if you know of people who might need a conversation like that, we hope that you'll refer them to Foster Group. You can certainly just send them a link to this presentation, and that'd be a good way for them to get a hold of us. This week, we're going to talk about kind of the state of the markets and the economy that we've seen in the last couple of weeks. And then we're going to talk about a concept called headline risk, which is really something I think that will affect all of us in the second half of the year. First, just a little news about things since June 27th, which was kind of the date of our last update. We went to a every other week rhythm for these now. One of the things you'll note in this chart is that COVID-19 new cases in many states continue to rise. Florida set a record for the country just over the weekend. Daily new cases are averaging over 50,000 since June 30th. That continues to get people's attention. Obviously, there's quite a bit more testing going on, but there's just a lot more positive cases out there as well. Additionally, unemployment and employment claims seem to get a lot of people's attention. Last week, the unemployment numbers came out. They were slightly better than the economic consensus, which was good, but the variation wasn't really large enough to be maybe more than estimation noise in the number. The good news is the larger trend is toward recovery. But as the graphs show, we have a long way to go before we get back to pre-COVID employment numbers. Also, continue to hear statistics that travel and entertainment related industries are just finding things rather slow, although there are some areas where things are starting to look up. United Airlines talked about some potentially very large layoffs as air travel continues to slow. We hear a lot about professional and collegiate sports leagues trying to get training camps open or seasons started, and that's being difficult as well. One of the good news is that the vaccine front, we continue to see progress, sometimes daily, as university and drug research companies race for vaccines and treatments. Because there are so many firms working simultaneously, this can sometimes be lost in translation, I think, from day to day. But really, there's a lot of good news. Just last week, the federal government announced $2 billion of awards. $1.6 billion went to Novavax, who has a vaccine in third-level trials. And part of that investment not only is in the vaccine development and trial, but they're actually pre-funding the production of the vaccine. So as these vaccines are tested and the ones that come out with positive results, they're actually pre-funding the production of the vaccine. So as soon as they know that the thing is actually effective, they'll be able to produce it in relatively large numbers. This Operation Warp Speed, the federal government's program, really is interesting to read about, and I think has some good news for us in the future. As far as market news, second quarter, really since July 1st, really started with positive equity returns inside and outside the United States. China had a particularly good start to the quarter. Gold prices continue to rise a bit as some speculators see slowing economic recovery. One thing to note there is gold last traded above $1,800 an ounce in 2011. It was trading slightly above $1,800 an ounce this morning. But it's been kind of a long, slow climb back for gold. People tend to think about that as maybe a defensive investment to hold or something as a hedge against inflation. It's not been the most consistent investment, but right now it's seeing some positive returns for people who are speculating in that commodity. Interest rates remain relatively low, and they've been kind of unchanged as monetary policymakers continue to just say we're going to keep rates low for as far as we can see, at least until the economy begins to recover. We see better employment numbers. Also, there's been some talk about whether inflation might be on the horizon in the future. The Treasury Inflation Protected Securities Market, or the TIPS market, is pricing in inflation over the next 10 years at actually less than 2%. So for people who are concerned about inflation, if you look at kind of the market consensus, it's very low inflation as far as the eye can see. On the other hand, for people who want a little inflation insurance, if they're concerned about inflation, the TIPS market is a relatively inexpensive place to buy assets that are going to be very inflation sensitive. So if there is surprise inflation, TIPS could be a good investment if that's a concern. Again, the first half of the markets for the year, kind of the story we've been talking about since February and March. Big downturn through February, March, followed by a recovery, both in U.S. stocks and international stocks. You can see U.S. bonds there at the top of the chart, having a little bit of an adjustment there at the end of February and into March, but then recovering fairly quickly. If we look at the news just in the last couple of weeks, again, positive trends across equity markets. SPY represents the S&P 500 in the United States. The ACWX are stocks outside of the United States, positive numbers really since June 27th. And then if we look at just what's happened since the second quarter began, a little bit more positive outcome overseas in that ACWX. The S&P is doing fine as well. The aggregate, which is the bond market, is doing well also. I mentioned earlier that China had a particularly good start to the quarter. The Shanghai Composite is up over 15% so far in the quarter, as Chinese government has kind of indicated they're going to support markets and the economy. As a matter of fact, at the end of last week, they had to back off a little bit because they wondered if some of their population was investing too aggressively based on the way their stock market was climbing so quickly. As we move out of what seems like maybe the first phase of the coronavirus or the COVID-19 economy and the crisis there, and I'm not saying that we're done in any way, but I'm just saying it seems like we've kind of established a bit of a new normal here in the last few weeks. One of the things that I've been thinking about is what's next and how do we prepare for the next phase. One of the things that I think is next is something I'm going to call headline risks. We all get our news from different sources. You can see a variety of sources here. Each of these news sources has kind of their own points of view, the people who contribute to those points of view. They have their own editorial standards, their gates for content, all those things. And depending on where you go for news or where you go to find out information has a great deal really to do with how you feel about the state of the economy or how you might be thinking about where things are going. As I initially thought about talking about headline risk, I thought, well, I'm just going to talk about my pet peeves when it comes to financial news. One of my pet peeves is that when I watch CNBC every morning on Squawk Box, most of the time they talk about stock market indexes as just numbers. They don't give percentages. In this case, if you look, this was just from this morning actually. And if you look at these numbers, they don't give you what the actual value of the Dow or the S&P 500 or the NASDAQ was. They just show you, hey, an implied open, how many points is this thing supposed to be up? But if you look at those points, they don't necessarily tell you anything about percentages, which would be a more helpful piece of information. On days when the numbers are green, they don't really give people heartburn. On days when those numbers are red, they cause us to think more about just how far down that is. And as, let's say, the Dow Jones gets to be a higher and higher number, it's trading over 26,000, 211, the number we see in today's, is less than 1% of the value of the index. But if you see a number and it's red 400, that 400 can be kind of an eye-catching number, but you need to remember that we're comparing that to a number like 26,000 and thinking about the actual percentage loss. Sometimes when someone says, well, the Dow is scheduled to open down 400, that can seem like a very extreme number relative to the base value of the index. So that bothers me a little bit. Another thing that kind of bothers me is when commentators don't differentiate between a market recovery and economic recovery. And what I mean by that is sometimes a market commentator will talk about a V-shaped recovery or a U-shaped recovery, but they neglect to say whether they're talking about the stock market recovery or the economic recovery. Certainly what we've seen since the end of March is a V-shaped recovery to some extent in stock markets. But if we think about those unemployment numbers that we looked at earlier and how much further they have to go before full recovery, you'd say, well, that's been anything but a V-shaped recovery so far. That's much more of a U-shaped recovery. And many economists say the unemployment numbers will take quarters to maybe a couple years to come completely back. Two very different things, but depending on what the commentator is talking about, when they describe a shape for recovery, they really need to be precise as to whether they're talking about the market or the economy. The other thing about market news that really I think is not helpful for investors is they make today's news always seem very dramatic and consequential. It's as though the thing happening in the last 10 minutes is really going to have a long-term effect and should be taken into effect or impact in terms of how you position your portfolio. Every day doesn't have dramatic meaning. As a matter of fact, most days do not have dramatic meaning to our portfolios. So those are just an example of some headline risks from business news. But what are the big headline risks, I think, coming up for investors between now and the end of the year are things we all kind of know about going in. If we think about it, we know there's going to be a presidential election in the United States in November. We know that the coronavirus is going to continue to be in the news. There's going to be news every day about the state of things. We know that there's some social factors that are happening, some protests that have been going on. Those things are going to continue to be in the news from day to day. And when I think about headline risks, what I look at here is these kinds of pressures are going to continually come up in the news. They're going to create maybe some distress in the way that we think about the world around us. And we might be tempted, if we focus on these headline risks too carefully, to think we should do something to our portfolio based on what we're hearing in today's news. When faced with eye-catching headlines, we just want to remember that it's one headline of many. There will be many days of headlines, and each day there's multiple headlines. One of my favorite authors, Dan Kahneman, he wrote a book called Thinking Fast and Slow with his long-term partner, Amos Tversky. They were research partners. And he identified something called the focusing illusion. I think this is especially important for those of us who pay attention to the news. If we look at the news a lot, this quote, "Nothing in life is as important as you think it is when you are thinking on it." What he's saying is the thing that has your attention, the thing that you are focusing on in that moment can seem more important than almost anything else. And of course it isn't, but because we're focusing on it, it seems like it is so important. So I think as we head into the second half of the year, it's going to behoove us as investors to kind of know the sources of headline risk and think through how we process information, how we make portfolio or investment decisions. In the next 6 months, we're going to see elections, we're going to see pandemic news, protests, and stress. Remember these three things. News organizations, they want our attention. And fear is a very effective strategy for getting that attention. And therefore, advertising dollars. If they can get us to watch their news programs, advertisers will advertise on it, and they'll be profitable, which is ultimately what they hope to do as a news organization, is to gain eyeballs and also be financially viable. Political parties want to win elections. Demonization and creating fear of the opponent has been a regular strategy employed to win. It doesn't work so well when people finally get into office, but in terms of getting elected, it seems like both parties tend to resort to a strategy of making you fear what might happen if the other party were to win. It's not so much that they're trying to say, hey, we're the best. It's saying that that guy over there is the worst. So you need to elect us to save yourself from what might happen if the other team, the other party was elected. The other thing to remember is social media. I don't know how much time you spend on social media, but it seems like it's really a big part of our culture. Social media just generally doesn't have a journalistic ethic. Doesn't have consistent editorial review, doesn't have reliable, comprehensive fact checking. It's just a place where anybody can say virtually anything they want. Hyperbole, catastrophizing, exaggeration, reductionism, name calling, it's the norm. I think as we think about taking in information from social media, the term is buyer beware. Be very careful of what you're taking in and attaching too much importance to what you're reading there. So how do we resist the temptation to take investment actions based on this headline risk, this sense of fear, if you will? Well, you can limit the amount of news you watch and listen to. The 24-hour news cycle today really is the same 30 minutes over and over. There's not a lot of things that are happening all day, every day that need our attention. If we watch the news maybe 30 minutes a day, that's probably more than enough to keep us up to speed in terms of what's going on around the world. You want to remind yourself that uncertainty is normal. People are creating fear, talking about uncertainties in the future, but that's just the nature of reality. If people could really predict the future, there'd be nothing to fear because we'd already be fully prepared. But the fact is, the future is uncertain, and we need to kind of accept that, even though the news media makes it sound like, hey, this kind of uncertainty is new or worse, or to be feared even more than the uncertainty that maybe we've had in past historical times. The other things that I recommend is try to find calm voices on both sides of an issue to understand the motives and biases and values that go into talking about that issue, including your own motives, biases, and values, including your own strategies. So a book that I read recently called How to Think by Alan Jacobs has been very helpful for me working through something called the checklist. And he was referencing a book called The Checklist Manifesto by Atul Gawande. And that checklist manifesto that Dr. Gawande came up was originally done to help surgeons do a better job in making sure they had consistent results in preparing for important surgeries. Airlines use checklists all the time for pilots to make sure they go through a set sequence of review to make sure people are going to have a safe flight. So what about us as investors? Can we develop a checklist to help us deal with headline risk? Well, here's some suggestions maybe to put on your checklist for how to deal with that headline risk when the media noise starts to get loud and you start to wonder if there's something you should be doing with your portfolio because there's some fear in the air about some circumstance. First, maybe when faced with the provocation to respond, give it 5 minutes and get your body involved. Take a walk, chop some vegetables, get your body involved. Those rhythms of just actually physically moving can help your mind process the things as opposed to just sitting there and dwelling on it and watching it over and over again. Maybe you need to avoid the people and programs online and offline who fan those flames, who just create that fear, that tension. Remember that you don't have to respond to what everyone else seems to be responding to. It's not a requirement to do something just because you hear some piece of information that day. It seems like the news media, if you watch CNBC, for example, they're telling you should invest in a certain way based on today's news, but we don't need to do that. It's just their take on what's happening right now. I would also say seek out the best and fairest-minded people you can find whose views you disagree with, who can handle disagreement with equanimity and listen to them and think it over. It helps to hear both sides of the issue to recognize, hey, things maybe aren't as certain as I think, but if I can find people who can disagree with equanimity, in other words, they can listen to each other, they can have a reasonable conversation, I can see that maybe I still have reasons to be optimistic about the future. And finally, maybe the most important thing for investors is understand our time horizon and motivations. Your time horizons and motivations as an investor are likely very different than the timeline and horizon of the news story, the person or the network or the source. Oftentimes, our investment time horizon is very, very long, years, maybe even decades, whereas a news story is designed to get our attention in the next few minutes about something happening in the next few days. We all know what's coming in the next 6 months. There are going to be lots of headline risks that are going to try to get our attention. The thing that we want to be able to do is keep those risks from causing us to make bad decisions. If we know they're coming, we can prepare ourselves. If we develop a checklist, maybe we can deal with those things a little bit better along the way and maintain some peace of mind. This last thought from Dan Kahneman on Thinking Fast and Slow. He says this: the main point is not that people who attempt to predict the future make many errors. That goes without saying. The first lesson is that errors of prediction are inevitable because the world is unpredictable. It has been in the past, it will be in the future, it is today. We want to make good decisions based on our long-term best interests, our long-term financial plans. That doesn't necessarily include responding to everything we hear in the news media, especially as we enter into the next 6 months with so much going on politically related to the virus and also some of the social things we're dealing with. Hope you have a great week. We'll see you in a couple weeks with our next financial update. Thank you.